Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts there, Chokkalingam of Equinomics Research and Advisory and Senthil Manikandan of Newberry Capital join us on the show. Thank you to both of my guests for joining me. Today on Hot Money, we'll discuss the tile companies. Natural gas prices have come down significantly. Colgate hit a record high in trade again yesterday. So what's booming? What's causing the boom as far as Colgate is concerned? A lot of housing finance companies have started to recover from the lows that they posted. Is it time to accumulate housing finance company? Muthoot Finance has been doing well. It's trading at a 52-week high. Is it a stock that you would accumulate? And we asked them what's the top pick for 2019. It's the first day of 2019. What's the outlook going ahead? So those are the stocks that we'll discuss today on Hot Money. Let's start with the first stock. And the first stock is basically, it's a sector, it's a tile company. Natural gas prices in the recent past are down almost 35%, and that's why certain companies like Kajaria, Somani and the other tile companies which were facing significant amount of headwinds as far as this could potentially be a tailwind now. So could that be possible? Would you accumulate these tile companies or would you stay away? That's something that we're asking our guest. So Senthil, I'll start with you. Happy New Year first of all. Thank you so much for coming in. What's your view on the tile company? Will this benefit, and are you recommending tile companies to any of your clients?
Yes, Happy New Year to you and to all the viewers. First on the tiles segment, if you look at the sector, I think the sector has gone for a tremendous pressure both on the supply side and also on the demand side. Supply side, what was expected was there could be a shift from unorganized to organized with GST coming in, but because of the delay in EA bill implementation and things like that, I think the unorganized players continue to thrive in this market. And if you look at the new plants that are coming up in Mobi area, that are much more efficient and they are able to produce products at a much lower cost in par with the organized segment. So I think the supply is continues to outperform the demand. That is one major reason for all these organized players losing their margins quite comfortably over the last 2 years. And second things, demand, as we know, with RERA coming in and now with the liquidity crunch, I think the total real estate space has gone for a downturn. So with both supply and demand on the negative side for these tile companies, I think margins have took a heavy beating with fuel prices going up. So what has happened is all the bad things have happened and the stock price is also corrected to that extent. But until I see the supply side see some constraint with organized players getting more market share, I don't see any margin recovery happening in the space. So we just avoid the tiles at the home decor space. Okay, that's the view that's coming. Mr. Chokkalingam, are you recommending tile stocks to any of your clients?
Not at all. I mean, earlier I missed the bull run also.
Okay.
But then in my firm view, there was a bubble in the entire space.
Okay.
So that is the reason for the stocks falling 30 to 69%. So gullible people bought tiles company for 40, 50 PE, trailing PE. And surprisingly, in the last 2 decades, if you see this tile company, granite companies, they all have a thematic, massive bull run, and then they crash. This has become more or less a pattern for last 2.5 decades. So one should be very cautious. And yes, as you mentioned, gas prices are falling, margin can improve, but even after the crash, the valuations are not very attractive. So if at all somebody wants to invest, one may consider Kajaria Ceramics.
Okay.
But even that stock is trading at around 34 PE for current year earning. So if there is any small correction, one can consider Kajaria. But otherwise, I am not recommending any tail companies.
No, but valuations, you're saying that they've come up, but still, according to you, they're expensive. Because consumer goods usually trade, or consumer-facing companies usually trade at a slightly better valuation than the others. But despite that, you believe that valuations are still expensive for the sector?
Definitely, see, people who have learned last 2.5 decades will know, whenever bull run comes, even the tails are classified as a consumer theme. But it is not like a toothpaste or, why I am saying is that it is also related to the growth of the industrial economy, economic growth. It's not like other consumer product. Now, as he was also mentioning, the entire real estate sector is going through tough time. The inventories of real estate sector are anywhere from 2 times to 10 times of annual sales, and the price points are still very high. So I don't see room for another bull run in the real estate and construction. So these prospects of this so-called consumer theme depends on the real estate and construction activities also. So therefore, I am not very bullish.
Okay, fair enough. That's the view that's coming in. Both of our guests are not extremely bullish as far as the tile space is concerned. It's a clear avoid that they're saying. If someone wants to consider, Mr. Chokkalingam is saying, in case someone wants to consider among all the tiles company, Kajaria is something that he would recommend among all the counters. The other one, as he also spoke about FMCG companies, Colgate is another company which has actually managed to buck the trend. It's down 1%, but yesterday did manage to hit a record high in trade. What's working for Colgate? Is it time to still accumulate given the momentum it has in, or are valuations now too steep to consider Colgate? Mr. Chokkalingam, you have Colgate, which the momentum is clearly there with you. You are in a sector which is growing, because now when initially there was a threat of Patanjali and all, that actually seems to have died down, but valuations are still on the higher side. What should one do in such a scenario?
Those who are holding it can hold it. In case it rises another 5-10%, one should exit it. Because in 2019, I doubt whether FMCG, which had a solid run up in 18, can repeat it. It can repeat to some extent if political instability comes in and the whole market goes for a toss. Then this consumer theme can give some stability in the portfolio. But I doubt, whether solid run can happen, because if you see the volume revenue growth in single digit up around 7%, the rally I would attribute partly to the oil price crash, because the packaging of toothpaste needs the derivative of crude oil. So to that extent it is benefited. And even the volume growth for the same company has come down in the recent years, and I don't think in the next 2 years it is going to come back to strong double-digit growth, volume growth. So therefore hold, if there is any rally of say 10% or above, exit the stock.
But not enter at this point?
I would not enter after this recent rally.
Okay. Is that the view that you share on the entire FMCG space? I'm just asking, have you recommended any FMCG stocks at these levels to your clients, or is the sector according to you expensive?
Sector itself is expensive. Still I went wrong. I mean, because I did not recommend. But then what happened in 18? Only the expensive FMCG banks went up for that. But I would suggest something like a Britannia.
Okay.
Because the added advantage is that the sugar prices have fallen.
Okay.
And this FMCG company, one of the major users of sugar.
Okay.
So to that extent, plus it has been growing quite consistently. So that is a stock often I mentioned. But otherwise, I am a little cautious, because I have a view that 2019 would be opposite to what we saw in 18.
Okay.
I may be wrong, but I firmly believe that unless there is a disaster in terms of general election results, the 2019 year will be year of wealth creation. So there, other segments should take off.
Okay, Senthil, you agree? Are you bullish on Colgate, or are you also finding it expensive?
No, I'm finding it expensive, because traditionally, if you look at FMCG over the last decade or so, I think they are able to garner the people's mind share by the sheer strength of marketing and their distribution. But now with the new age of digitization and all this, there are new players entering the FMCG market and disrupting. Like the case of, if you look at the 2M brand, which is promoted by the Sanjeev Goenka group, they just started and they're eyeing for a 10,000 crore market cap within a few years. So I think it makes easier for new players to come in and garner more market share in this FMCG space. And particularly, if you look at the toothpaste segment, Colgate is a market leader now, around more than 50% share, but over the last 2-3 years, they have been continuously losing their market share. And further, the second issue is that the paste and the brush are heavily penetrated segment. So, for example, compared to the packaged goods segment, so the growth prospects are tepid.
Okay.
But valuations rate, if you see, it's trading at around more than 12 times price to sales, plus also on the PE terms or 40 times. Okay. So it's quite expensive considering the tepid growth for.
Okay. Any FMCG stocks that you've recommended to your clients recently?
So we prefer Nestle among the pack.
Okay.
Majorly because it has the largest foods FMCG company, plus the packaged food segment would grow higher than the other products, as the discretionary income is expenses going to higher on the next 3-5 years.
Okay, so that's the view that's coming in. Avoid Colgate at this point of time. Britannia and Nestle offer better returns to you in case you want to invest in the FMCG sector. The other sector which has actually again started to actually show a little bit of growth, at least on the stock price side, are the housing finance companies. But nevertheless, most of them have corrected significantly, almost a 30, 40, 50% also from the recent highs they are, but valuations have come down significantly. Mr. Chokkalingam, any housing finance companies that looks attractive at this level?
Certainly, stocks like LIC Housing,
okay,
and to some extent even Repco, both of them trade at around 1.3, 1.4 times book value. So they look quite attractive. But I don't think one can make a big money, as I said, for tail industry. To some extent, the similar logics are applicable here. Real estate construction activities are going to be dull, and even the housing demand is not going to be in strong double digit. That's my firm view. But certainly, after the crash, some of these two stocks look good. Even in terms of little momentum, one can look at the PNB Housing.
Okay.
Ultimately, I believe that it would be divested and at a good premium compared to current market price. So these are the 2-3 stocks one can consider. Okay.
So basically, let's talk about the stocks. So you spoke about LIC Housing Finance, you spoke about PNB Housing Finance, and you spoke about Repco. Is there, apart from the valuation, is there something that you like in the fundamentals of this company that you would pick these three over the others?
Normally, I follow value investment strategy, so I always look for bargain buy, provided the management is good, quality of balance sheet is comfortable. So from that perspective, these three look good, better.
Okay, and on the fundamental side, they are all three are better.
Certainly.
Okay, what about you, Senthil? Any housing finance company that looks good to you?
So in this space, we like the Aavas, it's a newly listed company. So particularly if you look at the entire housing finance market, I think there are players who are much focused on the tier 1 and salaried segment, likes of HDFC or LIC. So that's area where there is heavy competition from the banks also. So it's difficult to maintain the NIMs, and in this liquidity crisis area, I think the banks will be much more in a position to garner higher market share. But if you look at the other market like semi-informal and informal segment, I think the banks penetration is very less. So the housing finance companies can grow at a much higher rate compared to the tier 1 focus companies. So within this space, I think like Mr. Chokkalingam mentioned, Repco is one company, and the other thing is Aavas. So if you look at the Aavas, I think they are much focused on the western part. Majorly, I think Rajasthan and Gujarat is their core markets now, but they are slowly expanding into Maharashtra and Madhya Pradesh also. And entire book is retail focused, and 95% of their loans by the borrowers or these self-owned homes. So there is, if you look at the sourcing also, it's 100% in-house sourcing. So that's the reason I think their cost to income is quite higher than the other players, and their ROE is lower. But they have built up a team for the next 3-4 years of growth. So going forward, I think the cost to income ratio should normalize, plus the ROE should inch up. And recently also, I think from the NHB also they got a refinancing part. So I think going forward, their focus on the low income category and the informal segment should help them grow higher in the market.
Okay, what's the story with Repco then?
Repco, it's same like Aavas, but they are focused on the southern markets with Tamil Nadu, and the recent correction plus the ALM mismatch that they have recently, so the price to book value came down I think 1.2 times, but particularly with Tamil Nadu market being their core market with 60% of their loan book coming from over there, last 2 years as the real estate market has gone for a toss. First it was ban on sand mining. Then the government at the local state government is not seen as investor friendly, so not much happening on the ground. But over the next 1 or 2 years, I think the entire scenario will change, I think. So with this multiple, I think it's trading at a quite attractive valuation.
What about Aavas? What's the valuation like?
Aavas currently trades at around 3.2 times price to book on a 1 year forward basis. So considering the growth prospects, I think currently if you look at their loan book is around 4,000 crores. But over the next 3-4 years, they can at least grow at around 30% till they reach a loan book more than of 10,000 crores. So loan growth is there, and the asset quality is also good, and their credit appraisement is also good, having a in-house team and things like that. So price to book of 3 times can re-rate further once they show a consistent asset quality, because it's a newly listed company. You have to watch it for a 1 to 2 year time period how they maintain the asset quality as they scale up their business. It can be a re-rating candidate like that of Gulf Finance. So we have to wait and watch for the next 1 or 2 years.
Okay, Mr. Chokkalingam, if someone is looking to take a contra bet on some of the counters like Dewan Housing or an Indiabulls Housing Finance, which have corrected more than 50%, is it a wise choice for someone to do, or should they avoid on certain parameters that you believe they should not invest?
No, I would suggest that one can bet on Dewan Housing.
Okay.
As I mentioned earlier also, we have seen, the perception-driven risk for Infosys when the CEO quit. Then we are seeing it for Yes Bank now. Then we are seeing it for Dewan Housing. Now, if you look at the September results, the results are not giving any panic in terms of valuation or in terms of NPA.
Yeah.
So, according to me, the market perception has punished the stock much more than what it deserves fundamentally. So, there is definitely a chance. So, if somebody can take 10-15% risk, one can definitely buy Dewan Housing. The risk reward is very high in favor of the stock.
Okay. Fair enough. So housing finance, be selective. Dewan Housing Finance, obviously high risk, high return stock, but the other counters like an Awas Financer or an LIC Housing Finance or a Repco, which finds mention among both of my guests, is something that you should look at this point of time. The next stock is Muthoot Finance, and the reason we have selected is that when the entire market is not doing well, Muthoot Finance hit a fresh 52-week high in trade yesterday. What's working for Muthoot Finance, and should that be accumulated? We'll ask our guest. Senthil, what's your view on Muthoot Finance?
So I think the outperformance is majorly because of their Q2 results, where their gold loan book grew by 17%, with gold stock as well going around 10%. And their newly emerging segments like that housing finance plus microfinance is growing at a rapid phase. And there has been a slight improvement in the asset quality also. But considering the gold loan market where the banks also quite aggressive, I think the growth prospects will be limited. Much of the AUM, consolidated AUM growth has to be powered by the new segments such as housing finance or microfinance. And they're also venturing into the vehicle finance also. But considering all this, I think currently it stays around 1 year forward price to book of 2.3 times, which looks reasonable for the kind of asset quality they maintain. So we remain neutral at this point of time.
So between, if someone wants to bet on the gold finance, should they bet on Muthoot or Manappuram? What's the better of the two?
I think Muthoot being the largest player among the two, and if you look at the asset quality also, I think Muthoot stands out. I think I could prefer Muthoot. Manappuram is also venturing into, apart from the gold loan book they have, I think they are also venturing into the housing finance segment and also microfinance also. Microfinance hasn't been performing well for Manappuram because the southern markets like Tamil Nadu and Kerala, after the demonetization, there was a huge stress on their microfinance book. Slowly they are picking up. I'll wait and watch for the next 2 quarters how the microfinance book asset quality develops. But as of now, I think Muthoot stands out.
Okay, what about you, Mr. Chokkalingam? Are you advising your clients to get into gold financing companies?
Not really. The retail investor should be very cautious of one particular fact. If you look at Muthoot Finance, the promoter stake is 73.58%. Then your mutual fund 11.5%, and then foreign portfolio investor 10%. These three groups alone make up for 95% of the total stake.
Yeah.
So what is floating in the hands of retail investors is only 5%.
Okay.
So I have seen historically there is a strong correlation between the low retail float and high valuation. So perhaps that is also one of the possible reasons for the stock to rally. And many times this kind of rally is not sustainable. That's what I'm trying to say. But the company is decent, quality enough. But as he was also mentioning, it is already trading at around 2.5 times current year valuation, which is reasonably high for these kind of companies. So I would not suggest to buy at this level. Rather, one should be watchful of further rally, and they should use that to book profits.
Okay, and between Muthoot, if someone wants to play this between Muthoot and Manappuram, which is a better bet?
I will not buy either of these two. Okay. I would have my strong bias in favor of a Kerala-based bank like South Indian Bank,
okay,
or Karnataka-based Karnataka Bank, where personally also I have invested, my clients have invested. Because after 2003-04, this is the first time they are trading at discount to adjusted book value.
Okay.
And
both Karnataka and South Indian Bank?
Yes.
Okay.
Around 5 to 10%. This kind of discount I have seen only in 2003-04. Surprisingly, both banks have got net NPA, as good as or better than what Axis Bank, ICICI Bank have reported. And both banks have more than 1 lakh crore of business size. and which is very crucial for the consolidation because both are part of old private sector bank. And last 20 years, this particular segment, old private sector bank segment, has been going through the consolidation. Already 4 or 5 banks have been acquired. Starting from Nedungadi Bank, Bank of Madura, Lord Krishna Bank, Vaishya Bank. So I would believe that this consolidation process would continue. And this kind of quality banks which are available at discount to book value or around one-time book value, I would buy rather than buying the...
But my only question on this is that why the market doesn't seem to favor side? Because if you see the stock prices of both them, they are pretty much consistent. They haven't given enormous returns. So I just wondered, are you just buying it on based of valuation, or is there something else that you see, except for this acquisition theme that you spoke about? Is there something that you're seeing in the fundamentals that, excites you of both these banks?
If you want me to share my learning, I would be blunt. 95% of the investors are momentum players. I recommended City Union Bank somewhere around 2011 at 53. That time that was the best bank and it went down to 33. I was posed a lot of questions by my clients that I have to relook at my stock selection strategy. Now the same stock, after you adjust for bonus and rights, today it is close to 400 or 500. So this is the beauty of Indian market. And according to me, I may be wrong, only 5% of the retail investors are very smart, value investors. Rest chase the momentum and burn the finger, and examples are plenty. You have Wakarangi, Tree House. So there are n number. So one should not worry. Whether stock is doing well or not. You just look at 3 parameters: management quality, balance sheet quality, valuation. Market will reward.
Fair enough. So the gold finance companies, not the best time to invest. Muthoot better than Manappuram is the key takeaway that we got. Mr. Chokkalingam would avoid both, but he believes that if you want to invest, rather invest in a South Indian bank or a Karnataka bank. So that's been spoken about, and it's the first day of the new year, and we need to ask our guests what they believe. Then they are recommending to their clients could be the pick of 2019. So I'll start with you, Mr. Chokkalingam. We've discussed Karnataka Bank and South Indian Bank. What are you telling your clients to do in 2019?
So we have given a list of around 20 companies. Called it as a high conviction stock. And Andhra Sugar is among the top. I would say top 5 stocks. This stock I have been tracking for nearly 2.5 decades. The name is a misnomer. Though
it's a cement play also, right?
No, it's a chemical play.
Chemical play.
Actually, 95% of the profits are from chemical segments. They had 2 large sugar plants. One they shut down. And that shutdown plant has got a lot of land back. And it's a very diversified chemical play. It has got a caustic soda, acetic acid, also aspirin, which is US FDA approved, and now they are getting into formaldehyde, and they supply the rocket fuel for ISRO-fired rockets. So range of chemical businesses. Strong balance sheet. For the 50 years, they have been giving dividend consistently. And if you look at this current year first half, they posted 29 rupee EPS, despite having 11 crore loss in the sugar segment. So I am of the view that in 2019 fag end, you will see a rally in the sugar. When that happens, this company can post even 60-70 rupee EPS, and it also offers very good dividend. It also has 3 ventures. It has invested in AP Gas Power Corporation. It has got a subsidiary Josil, which supplies input to MNCs, and also it has got stake in Andhra Petro. So the consolidated EPS would be for next year, in my view, it can be even about 60 rupees. So I am recommending this stock as a multi-bagger stock for next 2-3 years. And most of our clients have invested, and I also have invested personally.
And just to think, how are the fundamental financials placed on this? Is it profit making? What's the margins that this click on?
Excellent. I mean, it is operating only in caustic soda and cement, but of late, as I said, chemical has become dominant business. This is a very rare company. Despite operating in 2 commodity cyclical businesses, in the last 20 years, the company has been posting consistently profits and giving dividend, phenomenal dividend. So the margin in sugar is a problem, as I said, but that's now become a small business. So in caustic soda, they have a high margin because they have invested in AP Gas Power Corporation, which gives gas-based power at a nominal cost, being a stakeholder. They also set up now coal-based thermal power plant for the captive, and they are also expanding, the derivatives of chloralkali business. So I believe it's a stock in evolution.
So we need to watch out for Andhra Sugar and Senthil, which are the stocks that you told your clients to invest for 2019.
HSIL. If you look at the past decade, I think HSIL has underperformed Cera. But now there is a restructuring in progress. So they are demerging their manufacturing business alone and their consumer-facing B2C business as two separate entities. So with this demerger, I think the B2C business will be the B2C phase of the entire consolidated entity, and the manufacturing will be taken up by the HSL. So the demerged B2C business will have a high ROC, and so that there will be better value unlocking from the whole consolidated level. And so this, as last Q2 con call, this has to happen within the next 4-5 months. So there is going to be a value unlocking play with respect to HSL restructuring is concerned. And if you look at the product segment also, I think sanitary ware, which is dependent on real estate, is going at a single digit, but their new products like pipes is going at higher growth rates. Plus their consumer appliances side, like the kitchen or the water purifiers or the water heaters, that is also growing at higher rate. So this newer segment plus the retail segment hasn't been performing in the last 10 years, but we have to watch it for whether they are breaking even at the operating level. So taking into consideration all these, I think it's a good play of the value unlocking thing.
What's the valuation like and how are the financials of the company?
So if you look at the revenue segment wise, we can demark into two segments. One is the building product segment and that's the packaging segment. Both contribute 50% of the top line level. Well, the packaging segment is a B2B business, so margins are quite low and it fluctuates based on the raw material, that is fuel cost. So first half has been quite bad with high crude oil prices and higher gas prices. Second half is looking good for the segment. So margins are between consolidated level, margins will be around 11-12%. And if you look at the current market cap is around 1,500 crores. So if you want to do a SOTP valuation, I think our estimate is around 3,500 to 4,000 crores is the combined SOTP valuation. So there is a lot of margin of safety at present, even after factoring in the B2B nature of the 50% of the business.
Okay, so those are the stocks that's been spoken about. HSIL is something that Senthil spoke about, and Mr. Chokkalingam spoke about Andhra Sugar. So those are the stocks that you need to watch out for your 2019 pick. But with that, it's a wrap on today's edition of Hot Money. Mr. Chokkalingam, thank you so much for coming in. Senthil, so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg.